the situation is becoming increasingly alarming. Recently, U.S. Treasury Secretary Scott Bessent demanded that the world's top financial leaders buy up American assets, as if the United States still controlled global finance. But it came across as an ultimatum: buy our debt, or else you will regret it. This wasn't diplomacy, it was open pressure in the spirit of Trump. And the most striking part? The dollar is falling anyway. Since the beginning of the year, it has dropped by more than 10% against a basket of 6 major currencies, including the yen, euro, British pound, Canadian dollar, Swedish krona, and Swiss franc. It's the sharpest decline in the past 50 years. No wonder investors are fleeing. The US already has $37 trillion in debt, and it plans to borrow another $514 billion this quarter alone. At this pace, the debt will grow by nearly $2 trillion more by year's end. If that doesn't raise alarms, here's another fact. In April, foreign investors sold $71 billion worth of US bonds. Of that, $23 billion came from China, while $15 billion was invested into gold in a single day. That means confidence in the dollar is already collapsing. At the same time, the US is imposing 50% tariffs on China, despite existing trade agreements. Apple has already lost $900 million, imports are down 19%, and Bessent is pretending everything's fine. Yet the economy has nearly stalled. Growth is just 0.3%, and markets are in panic. America no longer looks like a leader, it looks like a desperate borrower. So let's break it down step by step. Bessent's speech sounded more like theater than economic policy. He tried to present the US as a growth country, but it came off like a cry for help. Bloomberg reports that since January, the dollar has fallen 10%, and in just 2 weeks, foreigners sold $41 billion in bonds. Even Japan and Germany have paused their purchases, scared off by instability and the trade war. Bessent called the US the anchor of the global financial system, but when capital is leaving and the dollar is sinking, trust is eroding. The Bank for International Settlements has reported that central banks are shifting from the dollar to the euro and gold. Today, 38% of global trade already happens outside the dollar. Bessent talks about tax cuts and deregulation, but Congress warns this could add another $2 trillion to the deficit by 2030. That's not leadership. It's trying to sell a sinking ship. The question isn't whether Bessent believes his own pitch. The real question is, does anyone else? According to an HSBC report, major investors are already moving into the euro and Swiss franc. The euro rose from 1.09 to 1.13, an 11% increase in just a few weeks. Why? Because a 5% yield on US bonds no longer offsets the dollar's decline. And according to IMF data, July saw a large-scale wave of de-dollarization. More and more countries are trading outside the dollar, and for the US, that's critical, because it's the dollar that underpins its debt. Bessent claims US markets are a safe haven, but ignores the reality. Liquidity without trust is just an accelerated exit. It's like being invited into a burning house. No one's going in, they're all running out. The trade war with China has hit US businesses the hardest. Right now, the average tariff on Chinese goods is 50%, and as of May 2, 2025, the US eliminated the de minimis rule, meaning even shipments under $800 are now taxed. Costs surged immediately. Apple's CEO admitted that in just 1 quarter, the company will pay $900 million in tariffs. Annually, that's roughly $3.6 billion in extra expenses. The US economy is on the brink, and the ports are overwhelmed. A spike in imports is expected in July, 2.36 million containers, up 2.1% from last year. Retailers are racing to stock up before the next blow, because starting in August, the new tariffs kick in. According to Global Port Tracker, shipping volumes are expected to drop by 10% in August, and by November, by 21%. Companies are panicking and rushing to bring in goods early. But it's not China that pays the tariffs, it's American businesses, and ultimately, rising prices for ordinary families. Small businesses might not survive. The National Retail Federation warns that uncertainty is making it impossible to plan, and consumers will feel the impact. There will be fewer products and higher prices. The entire global logistics system depends on stability, but Trump's tariffs are disrupting that balance. Even after the trade deal with China, many tariffs remained in place. And now even Christmas sales are at risk. The U.S. Chamber of Commerce reports that due to tariffs on electronics, solar panels, and chemicals, companies are losing up to 30 to 40% of their profits. According to a study by the National Bureau of Economic Research, tariffs caused consumer prices to rise by 2.4% in May and 2.7% in June. This hits low-income households especially hard. Logistics companies like Maersk report a 15% increase in costs because shipping routes have to be restructured. Besson talks about long-term resilience, but businesses are already struggling. It's like telling a drowning person, just wait, you'll learn to swim later. But if even Apple is struggling, what can be expected of small businesses? And hidden beneath all this tariff chaos is a simple truth. America cannot manage on its own, especially not without China. For many years, the United States believed China needed them more than they needed China. That idea shaped trade and politics alike. But now it's becoming clear that the opposite is true. In reality, America depends far more on China than it is willing to admit. And it's not just about cheap imports. China remains one of the largest foreign holders of U.S. debt, over $750 billion. While it is slowly reducing this share, it still has influence over the market. If Beijing begins selling off bonds on a large scale, it would push interest rates up and undermine confidence in America's ability to repay its debts. Washington relies heavily on foreign investors, and China has long been one of the most reliable. But now it is shifting its funds into gold, euros, and other assets, sending a clear signal that it no longer wants to finance someone else's deficit. And that's not all. China controls 80% of the world's supply of rare earth elements, materials critical to the functioning of every major American tech company. Establishing domestic production is not a matter of months, but of several years. The myth that the US can punish China by simply switching suppliers is collapsing. Most retailers still buy from China. No one else can match that scale and speed, and China knows it. It has long been developing alternative markets in Asia, Africa, and Latin America through its Belt and Road Initiative. The world no longer leans on the dollar, and certainly not on American promises. When trust fades, countries don't just move away from the dollar. They flee to gold, an ancient but reliable form of protection. In July 2025, the price of gold soared to $3,350 per ounce, nearly 40% higher than a year earlier. Countries and central banks are buying up gold in a panic amid tariff wars and growing instability. The biggest buyers are China and Poland. In 2025 alone, they purchased 244 tons of gold. China added 50 tons in February and continues buying every month. Poland bought 90 tons last year and aims to raise gold's share in its reserves to 20%. It already became the largest buyer in 2024. According to the World Gold Council, 95% of central banks will continue buying gold in 2025, and 73% expect the dollar's share in global reserves to drop to 57%, 10% lower than 5 years ago. More and more countries, especially in BRICS, are switching to settlements in national currencies, bypassing the dollar. JP Morgan forecasts that if trade conflicts persist, the price of gold could rise to $3,675 by the end of the year and break $4,000 by mid-2026. Even ordinary Americans are starting to worry. Economist Peter Schiff openly stated, "The era of the dollar is ending. Life in the US could change, and very quickly. A weak dollar means rising prices for everything, from food to electronics." Small businesses are suffering from supply disruptions, tariffs, and expensive imports. And if central banks buy up to 900 tons of gold in a year while continuing to dump dollars, the US economy could enter a deep crisis. And while the world moves to gold, the US continues to live on borrowed money, hoping someone is still willing to fund its deficit. But what if no one is left? Still, in this hope, the US continues borrowing at a frantic pace, as if tomorrow will never come. But tomorrow is already on the horizon, and it's frightening. In the first quarter of 2025 alone, the Treasury borrowed $514 billion. Interest payments have reached $1.1 trillion and continue to grow. That now accounts for 20% of all federal revenue, according to the Congressional Budget Office. In April, foreign investors sold $71 billion worth of U.S. debt. In July, Fitch downgraded the U.S. credit rating to AA, citing fiscal pressure from tariffs. Also in July, the IMF warned of a potential refinancing shock. By the third quarter, bonds totaling $1.6 trillion will mature. According to June minutes, the Federal Reserve does not plan to cut rates. Inflation remains too high due to tariffs, but with negative real yields on bonds and falling foreign demand, this decision only slows the economy. It's like borrowing money to patch the roof during a hurricane. If investors continue pulling out, the U.S. debt bubble could burst, and no one will be prepared. But this is not just about the bond markets. Inflation and debt are already hitting ordinary Americans directly. Warning signals are coming not only from Wall Street, they're coming from kitchens across America. The Conference Board's Consumer Confidence Index fell to its lowest level in 12 years, while the University of Michigan's Consumer Sentiment Index for July came in at just 61.8, down 16% since December. Yes, inflation expectations have declined slightly, from 6% to 4.5%, but that hasn't improved the public mood. Americans simply don't believe that anything good lies ahead. This collapse in confidence is already affecting retail. Yes, sales rose by 0.6% in June, but only thanks to essentials, cars, clothing, and medical goods. Meanwhile, spending on electronics and appliances is plummeting. In May, retail sales fell by 0.9%, and auto sales dropped by 3.5%. Economists warn that even June's growth may be a false signal. People rushed to buy before prices climbed further due to tariffs. Financial pressure keeps mounting. The latest FINRA survey showed that 26% of Americans are spending more than they earn, the worst figure since the 2009 crisis. Only 44% said they can comfortably cover basic expenses. Credit card delinquencies are rising, especially among middle-income families. Banks aren't sounding alarms yet, but this already signals growing risk in consumer debt and commercial real estate. This puts the Federal Reserve in a corner. Inflation is still too high, but with falling confidence and shrinking spending, pressure is building on the Fed to cut rates. The problem is that most consumers don't believe anyone will really help them. Big banks like JP Morgan and Bank of America say the situation is stable, for now. But Wall Street is getting nervous, and beneath the surface, fear is quietly spreading. So how much longer can Washington pretend it has things under control when everyone else is already starting to step back? To stay on top of what's coming next, don't forget to subscribe and turn on notifications. This story is far from over.